We are back. Today is day 12, risk management, and we will be learning the hidden secrets on becoming a long-term profitable trader. Today is all about protecting and preserving your capital and long-term prosperity. Now in today's module, it's a 4-topic module just like previously. We will be going over developing a risk-off approach, followed by the major impact of high-risk trading, then compound interest, and today we'll finish off with risk to reward ratio. So a very packed module. It's extremely exciting. This is fundamental to your trading success. Risk management and trading psychology, which is day 13, are very, very important modules. Now in yesterday's module, which was day 11, confluence, we learned that confluence provides additional confirmation, and it can be used to an advantage when trading harmonic patterns. So instead of just trading a bullish bat or a bearish Gartley, we can look for support trend lines, we can look for channels, we can look for pennants and wedges, and anything that can support our vision. Now your trading checklist is what keeps you on the right track, and I want you to follow this when analysing assets. Of course, as mentioned, it will change as you progress as a trader, as you advance through your trading career. Your trading checklist just now is simply a guide to get you trading the same setups that I look for when analysing different assets. You also learned about multiple time frame analysis, which can provide a clear view on market direction, short term and long term. So we have our 3 different time frames: minor, intermediate and major. And when we combine this with our technical working tools, it provides an in-depth approach. One that we can use to find only the best trading opportunities the market has to offer. And that's what it's all about. We're only looking for the best possible opportunities, and we're looking to limit losses. Now in our first topic today, developing a risk-off approach, I will go over the different types of risk profiles. Today's module, I'm going to take a little bit slower than previously. We've been really heads-on the last 4 days or so. We've been in the charts every single day, analysing different assets. You've been learning different technical working tools. Well, today, I want to take my foot off the gas. I want to take my foot off the pedal. We'll slow it down. We're not going in the charts today. We're crunching down the numbers. I want you just to take in all of this information because it is an extremely important module, as mentioned before. It is fundamental to your trading success. So I want you to listen up, take in as much as possible, and just enjoy the information that I'm going to provide. Now, as we know, trading or investing, it carries a risk. When you have a potential profit, there is a potential risk. I'm pretty sure a 7-year-old would know that. We know, everybody knows that when you come into trading or investing, there's a risk. There's a risk to lose money, and that's why many people call bullshit on it. They say, oh, that'll never work, or when you start a business, or when you start anything, because there's risk. There's a risk that, well, maybe it just might not happen. And for most people, that's the way it goes. And that's why there's this kind of mindset where people just don't want to try new things because they don't want to seem like a failure. They don't want to be seen losing money. So wherever there's a potential profit, there's always a potential risk. And this doesn't just apply to trading and investing. It applies to business. It applies to property. It applies to even just flipping cars. There's always a potential risk when there's a potential profit. Now, typically new traders seek out the biggest returns they can. And what they do is they eliminate the potential risk. And I don't mean in the market. I mean in their heads. They eliminate it in their heads, and there's just no risk whatsoever because all they're thinking about is the money they can make. They're thinking about the money they can make so much that there's just no risk at all. And this is where it goes wrong for pretty much 90% of the market. Wherever there's a higher return, if you go out and you seek the lottery win every single time you're trading, you're going to be faced with a higher risk. I mean, for most of you here, or just any average person, how many times have you played the lottery and how many times have you won? It just doesn't happen. The chances of you winning are absolutely minimal. I couldn't even tell you the percentage of winning because it's so small. Now, when you go out and you chase that lottery win in trading, it's the exact same. The chances of you making that successful trade, making that successful investment is slim to none. And on the downside, you're going to blow your entire trading account. You're going to lose all of your money. And that's what happens over and over and over again. And I see it every single day in the market. There's people that lose their entire pensions just by failing to follow simple risk management rules. And I wasn't lying when I said that. I've had many people contact me in very desperate situations just because they've failed to manage their capital correctly. And this isn't to scare you. I'm just providing facts. I'm getting real with everybody here. I'm just telling you what actually happens out there on a day-to-day basis. The market is not an easy place. So what we're going to do, don't worry. I mean, I'm not trying to scare you at all. What we're going to do is change that situation entirely. That's not going to happen to any of you. We're going to change that entirely, and we're going to flip this situation on its head. So we're going to have lower risk with a higher return. And we want to ensure that we're making consistent returns month to month, long term, with low risk. Now, every trader develops a risk management profile in relation to their strategy. So they'll have a trading strategy and they'll have risk management rules that align with their strategy. Now, when I say every trader, what I meant was educated traders, traders that know how to trade, that make profit. For most traders, they don't really have that. They don't go as far as developing a risk management profile. They'll maybe follow someone on TradingView and copy their analysis and just hope for the best and cross their fingers. But when it comes to being an educated trader, they'll develop a risk management profile that relates directly to their strategy. Now, typically speaking, there are 3 different risk management profiles. Conservative. Now, I'm a conservative trader. You'll typically risk 1 to 2% per trade. Now, there's a key lesson here, and it's on the size of your account. Now, for the most of you that are joining or have joined Six Figure Capital, you'll be trading with maybe a couple $100 or a couple $1,000. And I know many of you coming through this course do have a lot more starting capital. You do have capital upwards of $50,000. There are people like that that are in the course, and they're just looking for solid education. But for most of you coming through, you'll be like me when I started. I didn't start with 5 figures or 6 figures. I started with a 4-figure account. So for most of you, you'll be starting with $1,000. So you'll be looking to risk 1 to 2% per trade. You want to, of course, grow at a rate consistently long term that protects your capital, but you don't want it to be too small that returns are minimal and it takes forever for you to grow your trading account and actually see substantial returns. And don't worry, we will crunch down the numbers today. Whereas when you have a high-end 5-figure or 6-figure account, possibly even 7 figures, for most of you, you will get to that stage. For many people coming through this course, if you're dedicated and you persevere, you will get to that stage where you will have 5 or 6 figures in your trading account. Now, once you get to that stage, this is when you want to take your foot off the pedal, your foot off the gas. You want to take a step back and then look at reducing your risk. You want to, the more money you make, you want to reduce your risk. So you don't want to be risking 2% per trade. You then want to limit that, and you'd possibly looking to trade 0.5% to 1% or 0.5% to 1.5% when you've got larger trading capital. Now, we can confidently risk, even if it is a 4, 5 or 6 figure account, we can confidently risk 1 to 2% per trade. Now, there are people who have a moderate trading strategy, which is 5% per trade. Now, in my early stages of trading, when I found a grade A setup, what I would say grade A setup, when everything ticked the boxes, and I pigeonholed this trading setup as an 80-90% hit rate. In my mind, there was very little downside, and the upside of this trading situation was a substantial profit. And I would risk 5%. And a lot of the times it would pay off. Now, this isn't something I would recommend because it is a sure way to go broke as well. And it's a sure way to obviously blow your account. But the reason people blow their accounts and the reason people lose their money in the first place is one, they're over risking, and two, they don't know how to manage their risk. Now, when I was risking 5% on these odd trading situations, it wasn't frequent. It was maybe every couple of months or every second month. I had this one situation where I just knew it was a 5% trade. And I knew how to manage my risk. Every other time I was risking 1 to 2%. Now, this was when I had a small account. I'm now trading a much larger account. You would never see me trading 5%. It's always 1% per trade, very rarely 2% per trade as well. So we do have that option. There is a moderate risk management strategy, but I can tell you it is not sustainable long term. You cannot consistently trade 5% every single trade. For instance, let's say you have 3 losing trades in a row. You've already wiped 15% of your trading account. So there is a large risk there. Whereas if you have a conservative strategy and you risk 1% a trade and you lose 3 trades, you've only lost 3% of your entire account balance, which is minimal. Now, the third risk management profile is an aggressive profile. And these are typically this is more by the guys that you see on Instagram or maybe network marketers, for example, and they'll say, and it's these bullshit posts, people they'll say, I woke up this morning and I thought, fuck risk, and I'm going to risk 10% or 20%. And these are the kind of guys that are trading demo accounts and they just don't make money. You'll see it over and over and over again. People saying that they don't care about risk and they're risking 10% a trade. And they say, oh, you can make a lot of money trading Forex. All you need is $500. They're lying to you and they're lying to themselves. You cannot consistently trade 10% every single trade and be a long-term profitable trader. It just doesn't happen. It may work for a month or 2 months and you may have a win streak, but as soon as you hit a period of losses, I can tell you for a fact you will blow your account 100%. And this is why most people lose money, because they don't understand the simple concept of risk management. They come into the market, they risk whatever they want, whatever they please, and they expect to make, they'll have $1,000 and they'll expect to make 10,000 consistently within 4 months. It's just not going to happen. On a very rare situation it might, but for most people, and this is 99% of the market, it just won't happen. So an aggressive risk management strategy is mainly the main people that you see using this are losing traders, people that are marketing, and the kind of people that are posting pictures where they're trading 20 lots, 5 lots, 1 lot, and half a lot in the same picture, and you just know that they're trading a demo account. Nobody in their right mind trades the kind of positions. Nobody trades 20 lots and half a lot in the same account. That just doesn't happen. So an aggressive strategy, not sustainable long term. You may have a period short term where you can grow your capital significantly, but there is obviously, you've got that higher risk. You're chasing the lottery wins rather than using the conservative strategy where it's 1 to 2%. Now, throughout the 14-day course, or day 12, I should say, I will be crunching the numbers. And I'll explain to you exactly why an aggressive strategy is not sustainable long term. I think you guys get the gist by now on why it's not sustainable. For example, 10% per trade, you lose 3 trades, you've already wiped more than 25% of your account. You've almost lost a third of your entire trading account balance. For example, if you have a $10,000 account and you lose 3 trades, just 3 trades, then you've lost $3,000. $3,000 in just 3 trades. Then, of course, making that back is not as easy as just placing another 3 trades. And this is something I'll go over today. I personally risk 1 to 2% of my account balance, sometimes even less than 1% per trade, and this depends on the asset I'm trading. Now, for example, We're talking about trading here, so we have 3 different risk management profiles for trading: conservative, moderate, and aggressive. Now, an aggressive strategy could be applied on an investment situation. Let's say, for example, you're investing in cryptocurrencies. You could apply an aggressive investment strategy, and you could have 10% of your capital invested in 10 different assets. So you've got your risk spread across 10 different assets in cryptocurrencies. Now, when it comes to cryptocurrencies, for example, most people just go all in on one thing. They'll just go 100% in Bitcoin. And of course, that's why many people lose money. Now, I am a conservative trader. I always look at the downside before I look at the upside. I'm looking to limit risk as much as possible. I only risk 1 to 2% of my account, and I highly advise you do the same. Now, this provides long-term sustainable growth at low risk. So you're protecting your capital, you're preserving your capital, and of course you can grow long-term. The more you lose, the harder it is to make back. And this is why I'm just trying to lay the groundwork here with risk management. I'm trying to paint a picture for you of why an aggressive strategy is just not a sustainable route for trading. Let's say, for example, you had $10,000 and you lost $5,000. So 10,000 minus 5,000, what does this make? What is the percentage? Well, you've lost $5,000, it's a 50% loss. Let's say, for example, this was an aggressive trading strategy you were using, an aggressive risk management profile. That would only be 5 trades, around about 5 trades, maybe even just less than that. Now, to get back to break even, you would now need to grow your trading account by 100%. So you've lost 50%, but the increase to get back to break even, which is your original figure of 10,000, is not a 50% increase, it's actually double. You now need to double your money to get back to 10,000. So the more you lose, the more your trading account depletes, the harder it is to make that money back. In a good trading year, a profitable trader will turn over 100%. Over a 12-month period, a good performing trader long term will turn over 100%. Ask yourself this when you're trading. If you think about risking 10% or 5%, just ask yourself, are you willing to throw away a year of hard work? If you lose half of your account, are you willing to throw away a year of hard work? And this will hit home with some people, because many people coming through this course, they're not just beginners like many of you. They have been in this situation where they've lost 50% of their trading account, or they've lost their entire account. So this will be hard for some people to take in. It will be a hard pill to swallow. But this is why you're doing the course. You're changing your trading for the better. We now know that an aggressive strategy is not sustainable, and the way forward is a conservative approach to the market of 1 to 2%. Now, what I've done here, and to make this simple for you, I've got a trading situation. On the left hand side, we have 3 columns. We have trade number 1 to 10. So 10 trades, and let's say this is over a period of 1 month. We have an account value of $10,000, and we have 1% risk per trade. So we're risking 1% of the account value. So if the account value is $10,000, which it is, then we're risking 1% of that, which is $100. 10% would be $1,000. Now on the right hand side, again, we have trades 1 to 10, and let's just assume this is on a monthly basis. We have an account value of $10,000. We have 10% risk per trade. So what we have is a conservative strategy on the left and an aggressive risk management strategy on the right. Now, if we look at the figures on the left, we go through 10 losing trades in a row. And that is hard for a trader to experience. 10 losing trades in a row. That doesn't happen often, but for most people in the market, it does. Of course, most traders lose money. At least 90% or 95% of traders lose money. And many people will experience this, where they go through a trading month where they lose possibly 7 or 8 trades in a row. In this situation, It's extreme. We've lost 10 trades in a row, starting off at an account value of 10,000 on the left, and we can see the account depletes, but ever so slowly. At the end of the month, after the 10th trade, the account value would be $9,000.45. So $9,045. That's less than a 10% loss on your starting balance. Now, let's take, for example, the 10% risk per trade. You have a bad trading month, a really horrible month, and you lose 10 trades in a row. You start off with $10,000, you risk $1,000, which is 10%. You're now down to 9. You then risk $900 because that's 10% of 9,000. You're down to $8,100. And this just continues throughout the month until you get down to your final trade at trade 10. You risk $3,876. You have $3,876. You risk $387, which is 10%. And at the end of that trading month, you now have $3,489 in your trading account. So you started with 10,000, and you have now lost 2/3 of your trading account just in 10 losing trades. Whereas in situation 1 on the left hand side, you have lost less than 10%. 10% loss after 10 trades in comparison to possibly a 66% loss. And this is why we never risk 10% per trade. You can see how quickly you can lose your capital. Now, these figures, these apply to, obviously, if you had $1 million in your trading account, if you had $100,000 in your trading account, $1,000, the figures, the loss will still be the same. If you had $100,000, you would then have around about 34k after 10 losing trades. Imagine going from 100,000 down to 34k after just 10 losing positions. Whereas if you had 100k on the left hand side and you were risking 1% per trade, you would still have $90,000. And this is why we use a conservative approach to the market. What can we take away from the previous example? I've broke this down quite a lot, but we have learned that risking 1% per trade after 10 consecutive losing positions, so 10 losing trades in a row, you will have a drawdown of less than 10%. To regain those losses, you will now need to grow your account by only 11%. So you've lost 10%, almost 10%. You only need to make back 11% to regain those losses. So an extra 1%. Risking 10% per trade after 10 consecutive losing positions, you will have a drawdown of 65%. So a drawdown is where you have a sustained period of losses. 65%, that's a huge loss. So I did say previously it would be around about 66%. So almost 2/3 of your trading account. Now to regain those losses, you will now need to grow your account by almost 200%. That is 3 times the account value. 3 times. And as I mentioned before, in a good trading year, a profitable trader will make 100%. Some traders may make as much as 1,000% in a good trading year if they're using small capital. But 100% in a good trading year for someone trading with low risk. Of course, there is potential to make much more than that. But to regain those losses, 200%, 3 times your account value. Now you may be thinking, what is a drawdown? I just mentioned previously a drawdown of 65% or a drawdown of 10%. It is simply the reduction of your capital after a series of losing trades. It is calculated by the difference between the peak and the trough. And this is something we covered at the very beginning of the 6-Figure Capital 14-day course. We covered peaks and troughs. And this is typically shown in percentages. If you look at my FX book, for example, and you have track records, you will then see something called a drawdown. You need to accept that drawdowns are a part of the business. They will happen to all of you. You cannot just go through trading with a 100% track record and just have a 100% hit rate. You will have periods where you may have 3 consecutive losing positions. You will have a short drawdown period in your trading account. It is your sole responsibility to limit these drawdowns and be able to operate as normal throughout these periods. So this shouldn't affect you emotionally at all. When you experience these drawdowns, they are perfectly normal. Everybody loses money in trading. We just limit those losses. I lose money. Okay, I lose money in trading, but of course, my profit, my wins in trading, they outweigh those losses. Of course, everybody is going to have losing positions. Everybody. There is not one trader on this planet that has won every single trade or has made every single investment they've made has been successful. Everybody fails. Everybody has losing trades, and that is something I just want you to understand. When you have a drawdown period, let's say you have 4 losing trades in a row, you're not the only person. It happens to everybody. Everybody will have those situations in their trading where they have a bad month or a bad week. And I just want you to understand that so you don't panic during these situations. I want you to operate as normal, stay calm, collective, and just analyze your charts as normal. Now, a drawdown is typically, this is what it will look like. You will have a sustained period of growth. Let's say you had grown your account by 80% and you hit something which we know as a peak, which is the highest point. Then you experienced something called a trough. Now this would be your drawdown period. Now this drawdown period right here, it is the difference between the peak and the trough, and that is how you calculate your drawdown. Now your trough may be a 60% decline if you had an aggressive strategy, and this is what I've used as the example here. Now your drawdown, if you're using a conservative strategy, will be far smaller than the one shown in this chart. This one is extremely more excessive than a typical drawdown. If you're using a conservative strategy, you may have increased your account by 8% and you'll have a drawdown of possibly 2 or 3%. And then, of course, you may increase your account by a further 20% and then maybe a 5% drawdown. Whereas in this situation, it looks typically like a 100% increase on capital followed by a 60% drawdown. And then you obviously go from the peak to the trough, followed by a further move up, and then you create another peak. And these drawdown periods is just a consecutive period of losing positions. Now, this is a key part of the major impact of high risk trading that I wanted to get across, and it kind of aligns with the risk management profiles we were talking about. And it's what this topic's all about. I'm not trying to scare you. I'm just putting down the facts that when you risk a lot of money to make a lot of profit, it doesn't always turn out the way you expect. Now let's take the left hand side for example. We have percentage loss, a 33% loss on your account. Let's say you have $10,000, so you lose one third of your account. To regain the money you have just lost, you would need to grow your account by 50%. So when you lose 33%, you need to grow your account by 50% just to get back to your original figure. Then we move down to 50%. Now the difference from the previous loss, so the difference between 33% and 50% is 17. So 17%, if you lose a further 17%, you need to regain 100% to get to break even. So you now need to double your account just to get back to break even. Now if we lose a further 16%, so we've now lost 2/3 of our trading account, it would now take 200% to get back to break even. That's 3 times your trading account. We then lose a further 9%, so you're now at a percentage loss of 75%. To get back to break even, you would need to grow your account by 4 times your trading capital. We then lose a further 5%, which brings us to an 80% loss. By this point, this is the depression phase, capitulation. You just think your trading career is over. That's what most people think at this stage. And I can understand why, because you need to grow your account by 400% just to get back to your original figure, which is 5 times your account. So if you had $10,000, you now have $2,000 because you've lost 80%. You now need to grow that by 5 times just to get back to 10,000. You then lose a further 3.3%. This brings us at an 83.3% loss. You need to grow your account by 500% just to get back to break even. 6 times your trading account. And this just continues, and what we see here is a pattern. The difference from the previous loss gets smaller, and the percentage gain to break even becomes much, much larger. We can see that it's just going from 100%, 200%, 300%, 400%, 500%. The next figure, the difference from previous loss is less than 3%, I would imagine. It would be around about 2.7%, and you would need to grow your account by 600%. After showing you these numbers, I hope it will change your perspective on how you handle your money. Money's hard to make. It's not an easy tool. If you go out, for most of you, in your working life and you work 40 hours per week, you do that every single week for the month, you get your paycheck, it might be $2,000. Why would you deposit that $2,000 into a trading account just to blow it on 10 trades or just to blow it on 20 trading opportunities? I want you to truly value your money, learn how to handle it like a professional, treat your trading like a business. You need to treat your money as if you were already managing $1 million trading account. Because let's say you just get lucky and you manage to turn your $4,000 investment into $150,000 or $200,000. What are you going to do when you get to that stage? If you don't know how to trade correctly, you don't have the correct risk management profile, and you're risking 10 or 20% per trade, what are you going to do if you do get lucky? You'll just blow it. You'll lose it because that's all you've ever known. This is why it's extremely important to develop these habits from day one, because if you don't, and I mentioned this way back at the start of the 14-day course, it only takes on average 66 days to develop a habit. And that one, it could be a bad habit. And that is something you don't want to develop. You need to be constantly analyzing your potential risk to prevent, obviously, developing bad trading habits. Now, the most realistic piece of advice you will probably hear in this entire course is that it does not matter how much money you trade with. If you're not a profitable trader, you will consistently lose money. And that is the cold, hard truth. Now, I hope you guys have learned a lot just from these past 2 topics. I've been quite hard on in this module. I'm really hitting the nail on the head. I'm trying to be as serious as possible here, just so you guys get the message. I don't want anybody here losing money. I don't want to see that happen. Now, I know it is a part of the game, it's a part of the business, and people will lose money. That's why the market exists. That's why 95% of people that trade lose money. But if I can do my best to prevent that from happening, then I've done my job right. What I'm going to do now is just take a short break, and then we'll continue the rest of day 12. Alright, I've took a short break. I'm energized, I'm ready, I'm back. Let's continue the rest of day 12. This is topic 3, compound interest. Now, for many of you, you will be thinking, what is compound interest? If you have previously traded or invested, you will know exactly what this means. It's interest calculated on your initial principal and on the previous periods of accumulated interest on your deposit. That is pretty much the official definition for compound interest. Now, simplified is basically interest on interest, commonly known as compounding. Compounding is the process of growing your capital, and that is why you hear of people making substantial amounts of money in Forex or in cryptocurrency or stocks, because they are compounding their capital. Once you truly understand the power of compound interest, your life will change indefinitely. And trust me, at will. Now, for most of you, you'll not have heard about this a penny doubled every day. And I feel like this is a very simple lesson that I can just put across to everyone. A very simple lesson on compounding. If you were given the choice to receive $1 million, which is a substantial amount of money, or a penny doubled every day for 31 days, which one would you choose? And just think about that for a moment. There's no right or wrong answer here. What would you take? $1 million or a penny doubled every day for 31 days? It seems like an easy choice. It does. Now, since the title is a penny doubled every day, most of you would have picked a penny doubled every day anyway. It's pretty obvious. But there is no right or wrong answer here. And what I'm going to do is break down the numbers. And, day 12, that's what it's all about. We're just crunching the numbers today. We start off with day 1. We have 1 cent or a penny. Day 2, it doubles. We now have 2 cents. We have 2 pence. Then day 3, it doubles again. Now when we get down to day 11, we're almost halfway through the month. We've only got $10.24. We get to day 16, which is the halfway point. 15 and 16 is the halfway point in the month. We only have $327.68. Now at this point, you're probably thinking, I should have took that million that I was offered before. You're halfway through this month, and the amount of capital you've got is pretty minimal. It looks extremely small. Now what happens between 16 and 31 is where all the magic happens. Nothing has changed before. We're still doubling every day. So when you double your money, it's a 100% increase. So 100% every single day for 31 days. We go from day 16 from 327 to 17, $655. Then if we look at our next day, we're now into the 4 figures. $1,310, $2,621. Down to day 22, we're now up at $20,971. But still, it's a long way from $1 million. You're at day 22, you've got less than 10 days left, and you're really thinking, wow, I really should have took that million. I should have took that $1 million. You get to day 23, $41,943. Followed by $83,886. Then day 25, 26, 27. Now at day 27, you have now reached $671,000. Now at this point you're thinking, I've still got several days left. I'm now going to make more than $1 million. And it gets to day 28, 1.3 million. 29, 2.6 million. Day 30, 5.3 million. Day 31, 10.7 million. This is the true power of compounding. When you build your capital, let's say we got to day 22, for example, and I want to relate this example. This is a widely known example, this penny doubled every day, or a cent doubled every day. It's a very widely known concept. Let's say you got to day 22 and you decided, I'm going to cash out. I'm going to take out $15,000. You're now back at $5,000. What you're doing there is you're actually backtracking your goals. You're taking 1 step forward, 3 steps back. Instead of allowing your money to compound every single month, you take out a large amount of capital that is no longer working for you. And the main purpose of trading and investing is to make your money work for you rather than you working for your money. And that is the main purpose. Of course, time freedom is important as well. But when it comes to a financial standpoint, it's about making your money work for you. And when you truly understand compound interest on a deeper level, it will truly change your life. And trust me on that. What I have provided today is a compound interest calculator, a very basic calculator that allows you to insert your initial capital, so the amount you will be trading with, and then your percentage return. Now your percentage return, you won't know what that is right now. You will only be able to identify this once you're trading a live account or even a demo account. You can identify your rate of profitability every month. This may be 5%. What I'm going to do is walk through this step by step. So let's head over to the compound interest calculator. Here we are on Excel with the compound interest calculator. Now what I want you to do is click the link below today's video. I have got this as a downloadable file. Download that, open it up, and you'll have the exact same file as I'm looking at here. Now what we have is the initial capital, and this is the amount that you want to deposit into your trading account. Now I have everything in pounds. The currency is totally irrelevant. What you're focusing on is the numbers. Now let's say we had $10,000 at 5% return every single month. Now this is a very common statement you see on Instagram or social media for that matter, just any social media. It's a picture that says, if you grow your account at $10,000 at 5% a month, you will have $1 million within 8 years. So that's how long it takes. 10,000 at 5% a month, you will have $1 million inside 8 years. So let's just find out how accurate that is. After 12 months of growing your account at 5%, you will have an additional 8,000. So we can see here the compounded balance is 17,958. 24 months, 32,251. Then we go into 36. So this is the end of year 3. 58,000, just below £58,000 or $58,000. Then we go to 48. Now you're into the 6-figure region. So within just 4 years of trading profitably at 5%, you've now hit the 6-figure region of 104,000. Then we go to the 5-year goal, the 5-year period, just below £200,000 or $200,000. The starting point was 10,000. We then go to 72, which is 6 years. 304,000. We can see how quickly this compounds every single year. Then we go to 84. 546,000. So over $500,000. Then finally, our 8-year goal, 96. And the following month, at the end of that month, we're then looking at £1 million or $1 million. So 10,000 at 5% a month over 8 years does actually make $1 million. It makes $1 million or £1 million. Now, what does it take to make 5%? Now, this really comes down to our risk to reward, which I will cover in our next topic, which is extremely important. Many people don't even focus on that. Many people don't even know it exists in risk management. It's a completely fundamental to your trading success. Risk to reward is extremely important. Your percentage risk, because of course you want to limit downside, but you want to have large returns as well. Now let's say for instance you risk 2% a trade and you make double every trade. So you risk 2%, but every trade that you make successfully, you make 4%. This 5% figure, that seems more than achievable when you just write down these simple figures. Even if you risk 1% and you make double every trade, so you're making 2% gain every trade. 3 correct trades per month and you've already made 6%. Let's say for example you had 10 trades in a month, and this is something you can write down. I would go off and do these figures in your own time so you can get your trading goals down on pen and paper, pin that stuff on your wall, print it off. I mean, get that clear, get your vision clear, your money goal clear on what you want to achieve, but it needs to be calculated as well. It needs to be realistic. So you need to know how you're going to get there. You can't just say, I'm going to grow my account by 100% every month. If you can't back that up with statistics on how you're going to do it, then I'm calling bullshit. You need to get the numbers down. So let's say, for example, you're risking 1% per trade. You're making double every trade, so you're making 2% profit every trade. You take 10 trades in a month. And let's say you get 4 trades incorrect. So you've lost 4%. However, you have 6 profitable trades, not at 6%, because you're making double. You've made 12%. 12% minus 4% for your losses. You've had an 8% gain that month. And these are the kind of figures I want you to work out when we finish today's module. Now let's say, for instance, you have a 10% gain month to month, and you'll see how quickly this compounds. After 12 months, you're looking at 31,000. After 2 years, you're into the 6-figure region. So if you can maintain an average of 10% every month long term, and trust me, this isn't an easy target to achieve, but if you can do it, this is where your account grows substantially. After 36 months, 3 years, you're up above 309,000. Then we're looking at 48. This is where your million is. So after less than 5 years, just 4 years at 10%. Now, this is a hard target to hit long term. Most traders won't be able to achieve this. But if you work on your trading consistently, you work on your ability every single day, I'm not going to say it's not achievable, because it is. And I know many traders that are doing it. 10% a trade, 10%, sorry, not 10% a trade, that's not realistic. 10% per month, sorry, is achievable. Many people will tell you it's not. Many people will say, well, you know, Wall Street, the guys on Wall Street and all these professional traders that trade at institutions, they're only making 5%. Well, yeah, because they're trading millions. They want to limit risk. These guys aren't trading 1 to 2% per trade. You know, they always look at the downside. They always look at the potential risk, and they increase their risk when they're winning. They don't want to they want to limit their exposure completely. That's why they're making 5% in a good month. Some of these people are trading with tens of millions, hundreds of millions. They don't want someone trading 2% of that per trade. That's why they're making 5%. They only need to make 5%. That's a lot of money. Whereas when you've got a small trading account, you're trading with 1,000. It's incomparable. You can't compare 10 million to 1,000. The guy that's trading 1,000, he's going to, of course, look at trading slightly differently, and he'll be more open to 1 to 2% than someone trading with 10 million. They've got a lot more downside in comparison to someone with trading a $1,000 account. Now, as mentioned previously, doesn't mean you should be treating your capital like a $1,000 account. You should be treating it like you're trading with $1 million. But all that changes is the amount you risk per trade. So 1 to 2%. So if you could aim, of course, the aim to start with is to become a profitable trader. You set your goals. You set your goals on what you think is achievable for yourself and your own ability. Everybody will have their own targets. This may be 2% per month, a very conservative target to make. Some people may be 5%, 10%. Many people as high as 15%. That could be their target for the trading month. You ultimately define what you want to make, and then you need to match that with your ability. Now, one point I want to get across is, let's say, for example, you made 4% and your target is 5% for the month. You've got 3 days left and you can't find any trading opportunities. What I don't want to see you doing is trying to push an extra trade just to meet your target. Let's say your target's 5%. Don't push an extra trade, maybe a mediocre trade, just to make your 5%, because what will end up happening is you'll lose a further 1% and you'll be back down at 3%. Then you'll try and regain that loss, and guess what happens again? You have another losing trade. You're down at 2%. And trust me, this does happen, and this is why most people are losing traders. It's all psychological, all small changes. So these targets that I'm telling you to set, they're more invisible targets. You don't need to hit them. If you fall short, you have a bad month, then go on with it. This is long-term targets. Over a 12-month period, what do you want your average return to be? 5% per month, 10% per month? I don't mean 5% every single month. You will have a bad month. You'll have good months where you maybe make 8%, and it'll average out over a period of 12 months. Now let's head back to finish off the rest of day 12. Now for our final topic today, risk to reward ratio. Now, as I went over in the previous example with the compound interest calculator, I explained that you want to have trading situations where you make double what you risk. So I want you to trade with a minimum risk to reward ratio of 1 to 2. And this simply means your potential profit should be double your initial risk. Let's say, for example, your risk is 100 pips. Your reward should be 200 pips, twice your initial risk. By using this simple method, you will automatically increase your chances of profitability. And you will often find trading situations with a risk to reward ratio of 1 to 3. Now for harmonic patterns, the stop loss and take profit levels we use, which will be covered in part 2 of day 12, these situations offer automatically a 1 to 2 risk to reward. Now many of our patterns, such as the bat pattern for example, that typically offers a 1 to 3. So you may be risking 1% of your account, which is 100 pips for example. With a bat pattern, it may be a bullish bat. You will be making 300 pips at your final take profit level, which is 3% per trade, 3% gain. Now that 5% target per month seems a lot more, it seems far more achievable than before. When you say risking 1% per trade, many people think, well, if I risk 1% per trade, I either lose 1% or I make 1%. And that's how most people think of it, and that's how most people trade. We're not like most people. And that's why we have high probability trading setups. We have high chances of being profitable long term. We aim to make double our risk as a minimum, the absolute minimum, 1 to 2. If I'm risking 1%, I should be making a minimum of 2% per trade. If I'm risking 2%, I should be making 4% per trade. The same goes for a bat pattern, for example, if it's 1 to 3. If you're risking 2% per trade, you should be making 6% on that trade. Now what I want to do is crunch the numbers even further on the left hand side, and this is a very simple example of risk to reward. What we have is a 50% profitability rate. So you win half your trades and you lose half your trades. We have a 1-to-1 with a 50% profitability rate. Of course, over 10 trades, you lose $100, you make $100 profit. You lose $100, you make $100 profit. And guess what? By the end of it, you're left with $500. Very easy. No profit at all, because of course, you lose 100, you make 100. You lose 100, you make 100. So what's happening here is your profit is being cancelled out by your losses. You're not making any more than you started off with. You started off with possibly 500, and what you end up with is 500. Now, on the flip side, we have a 1 to 2 risk to reward with a 50% profitability rate. We lose 100, but we know we're making double what we risk. We're making $200. So not only are you making back your initial 100, but you're making an extra $100 every single trade. You then lose another 100, but you make a further 200. And this just continues. And over just 10 trades, you will have doubled your trading account with a 50% profitability rate. Now, of course, this is a very simple overview, a very simple example. When risk management comes into play, when you're risking 1 to 2%, it's not going to be as easy as that. This is just a very simple overview of the power of just a simple risk to reward ratio when you apply it in your trading. And what I want you to do is risk 1 to 2% per trade, and this would be my personal advice. This is what I do. 1 to 2% per trade, and utilize a minimum 1 to 2 risk to reward. So you should be making double what you risk every single trade. For example, you will have maybe a crab pattern or a bat pattern where it's 1 to 3, or even sometimes 1 to 4, where you're making 4 times what you risk. Every 1% you risk, you make 4%. And this is what increases our chances of being profitable traders. Now on to rookie mistake number 12. You've covered rookie mistakes throughout the entire 14-day course, but I feel like this one is probably one of the most important. Going in big. And this applies to all new traders, even those who are experienced as well. I still see experienced traders doing this all the time. This is by far the number one death of all Forex traders, or just all traders for that matter, and investors. Oversizing positions and risking it all. Like I mentioned at the start of today's module, going for the big lottery win. Just going all out, risking $1,000 on one trade and crossing their fingers and hoping for the best. Most new traders assume money can be made easily. They get a few trades correct. They just guess. They guess the direction. And people can do that. It's not sustainable long term, but short term, you may get a few small trades correct. And then you become overconfident. They become overconfident in their own ability. And this is a very dangerous position to be in. They'll maybe have $1,000. They've doubled their account within 2 weeks. They're now up at 2,000. They don't have a clue what they're doing, but they just think the money's going to continue that way. Well, don't think like that. Don't think you're better than the market, because trust me on this, it will ruin you as a trader. Follow your risk management plan and become a strict investor, a strict trader. Risk 1 to 2%. This is how you keep your capital safe. It saves all of the stress and, the depression as a trader when you lose a substantial amount of capital that you've worked very hard for. Like I've said before, you go out, you work for your money. And again, I've been in this situation where I've went out, worked really hard for my money. When I first started trading, my first trading account was around about £3,000, and I blew the lot, the entire account. And at the time, I only earned just over £1,000 a month. So I blew 3 months worth of wages in one trading account. And that is a very hard pill to swallow. And I don't want that to happen to any of you watching my videos today. So let's just wrap it up. It's been a very in-depth module. I've been quite serious with you today. Don't think I'm like that all the time, because I'm not. When I've got certain facts or certain opinions I want to go over, I do get very serious. Especially when it comes to managing your capital, because the last thing I want you to see is losing money. That is the last thing I want. We're in this business to make money, and that's what it's all about. So strictly risk 1 to 2% per trade with a minimum 1 to 2 risk to reward. 1 to 2% risk, you should be making double what you risk. If you risk 2%, you should be making 4% per trade. If you risk 1%, you should be making 2% per trade. You will not be a consistently profitable trader long term with an aggressive risk management strategy. Now, I'm not saying it doesn't work, because there are profitable traders who use this as their strategy. They use this as their risk management profile, but they know when they can use it and when they can't. I'm not saying it doesn't work. I'm just saying long term, it's not sustainable. I don't know anybody with a 7-figure account that risks 10% per trade. It just doesn't happen. Now, when it comes to investing, this may be different. Possibly cryptocurrencies, you may see this happen, and people will put down 100,000 if their net worth is $1 million. But when it comes to trading, when it comes to Forex, commodities, or even trading cryptocurrencies, an aggressive risk management strategy, for me, personally, I would say is not sustainable long term. It burns out so many traders. And as I've mentioned multiple times, it is the primary mistake of every new trader, and even experienced ones as well. If you want quick money, go to the casino. It's as simple as that. I'm here to keep you in business. I'm here to make sure that these losses don't occur, give you the correct advice. I don't want to see people risking 20% per trade because they're going for the big win. I'm here to keep you in business. I don't want you going big on your first trade or your second trade. Keep your risk management strict. These simple changes in how you approach the market will change your trading indefinitely. And trust me on that, it will. It will change your trading completely if you just follow these simple risk management rules. Now, in our next module, which is Risk Management Part 2, again, day 12. So you can continue day 12, you can go straight onto the next module. We will cover capital protection, followed by numbers don't lie, then on to position sizing, and finishing off with trading tools. I hope you guys enjoyed today's module, and I'll see you on the next video.